January was a very, very tough start to the year, one of the worst starts on record for markets. Many markets down by 10% plus, and some markets down by actually quite a bit more than that, where stresses started to appear in the system. In contrast, government bond markets have actually performed well. Yields on government bonds have fallen very sharply this year, and other sort of safe haven assets like gold have also picked up in the course of this year, which reflects a certain degree of stresses appearing in the system. High yield and credit has also performed pretty poorly. We've seen rising spreads. So this has been a very, very tough start to the year. China's been a very significant factor behind the falls in markets over the last 7 or 8 months. China's slowdown in growth, which everybody now accepts is happening, it's structural, it's going to continue, and the rather inept way in which they've handled gyrations in markets, the equity market, then a devaluation of the currency, raised concerns about the economic competence of the administration. So it's been a big factor, and of course China is such a big part of the global economy. But it's not just China. The whole emerging market world has sort of gone into near recessionary conditions. Some countries in outright recession, particularly those that are heavily dependent on commodities, which of course have been in a long-term bear market. Those dependent on oil, which has fallen very sharply. So it's spread across the emerging world, and the deflationary pulse coming out of the emerging world is certainly impacting on the developed world and causing a slowdown in manufacturing industry in particular. We've then had a tightening in financial conditions. I've mentioned just now, we've seen credit spreads widen quite a lot in the course of the last few weeks. The falls in equity markets clearly have some impact on confidence. So all of that has tightened financial conditions quite significantly, and that's now being reflected in a slowdown in growth across the developed world, and expectations for inflation and interest rates have been changed quite materially. So anybody that went into this year thinking inflation was going to pick up has probably changed their minds by now. That doesn't look as if it's going to happen. And expectations for interest rate rises, which in the US were expected in the course of this year, they've been deferred quite a lot. So it's gone way beyond just China, this has, and there are definitely more stresses in the system. The biggest surprise is what has happened to the dollar. As the markets have repriced growth expectations in the US, ratcheted down, and expectations for what the Fed is going to do on interest rates, guess what? The dollar has fallen. The biggest consensus trade, I think, going into 2016 was that the dollar was going to continue to rise, as it had been rising for 18 months. Well, so far this year it's down 4% against the euro and the yen, and now people are saying actually the dollar is not going to remain strong because of these headwinds in the US economy and the fact the Fed isn't going to tighten rates. Big surprise, and it's actually helpful to markets because a strong dollar has been one of the damaging factors to the emerging world, which has borrowed so much money in dollars. So I think if we do see the dollar weaken off a little further this year, that's going to help the underlying sort of recovery in the emerging world in particular. I think that there are two big things that we need to reflect on. One, is the world facing sort of recessionary conditions, a very sharp slowdown in growth? And two, are the problems that we're seeing in the financial system systemic? As far as growth is concerned, yes, there is some slowdown in growth going on, sort of negative pulses coming from the emerging world and oil and commodity producing countries into the developed world. But they are unlikely to tip those economies in the US, Europe and Japan into a further sharp slowdown. Because remember, the consumer remains the big part of those economies, and the consumer is getting a very significant benefit from this big fall in the oil price and other commodity prices. That's going to flow through into disposable income and into spending as this year goes on. So yes, there's a slowdown, but it's not into a recession, and I think that slowdown is now largely discounted in share prices. Second thing, are the financial problems systemic? Definitely not. Banks are much better capitalized than they were going into the 2008-9 slowdown and crisis. Yes, they have some problem loans on their books from the commodity producers, oil producers in the emerging world. They're nothing compared with the mortgage debt problem they had going into 08, 09. So I just don't see these issues as being systemic in any way, shape or form. And I think what we've seen is an overreaction in markets. So when you get an overreaction, you get opportunity. Markets have fallen, the lowest levels for 3 or 4 years. Valuations have got better. Yes, it's a tough environment, but it's not that bad. So here is a very good opportunity to be adding to risk in portfolios, adding to those equity positions in particular.